Welcome to Retirement Shield, how to get retirement right. Did you know that statistics tell us that over 80% of Americans do not know how much money they need to retire? And 95% of Americans are not financially prepared for retirement. As a retirement planner, this is both upsetting and frustrating. I'm upset that most of you on this webinar are depending on the stock market to pay for your retirement and will be forced to make drastic and unwanted changes to your lifestyle. And I'm frustrated because I'm aware of how the investment advice community is charging consumers a lot of money and the results are absolutely not acceptable. I'm not even sure that 5% can be called a success, can it? For my 30-plus years of experience with folks just like you, I found 3 major challenges you face as you try to ensure that you'll outlive your money and not the other way around. That's why during this webinar, I promised to teach you how to solve challenge number 1, getting Social Security right. Challenge number 2, converting your retirement savings into your own personal pension that will last as long as you do. Challenge number 3, avoiding losses. That's my promise to you during this webinar. Now, after that, I'll be making a special offer. But regardless of if you take me up on that or not, you'll find tremendous value from this webinar. Plus, to thank you for showing up and being committed to achieving these goals, I'm going to also give you a retirement calculator that will show you where you stand so you can see if you're on track for a successful retirement or not. I'm Jerry Rogers. Our firm, Rogers Tax Advisory Group, equips near retirees and retirees with the knowledge and the tools to accomplish their retirement goals. We've handled tens of millions of dollars on behalf of our clients and consistently provide safe, very low-cost solutions that allow them to have peace of mind during their retirement years. As we go along, send in your comments, questions, or suggestions. I'll cover those a bit later and make sure you get everything you need. Okay, let's get started. So here's how you solve challenge number 1, getting Social Security right. Step number 1 is to determine what is known as your full retirement age. It's the time that you can collect 100% of your benefit. Your full retirement age is going to depend on the year you were born. So check the chart, find the date of birth, and the chart will tell you what Social Security considers your full retirement age. Now, if you start taking benefits any time before that date, you're going to take a reduction in your benefits. So here's your 3 main options. In column 1, you see that you can choose to collect benefits early. You can collect your benefit as early as age 62. And if you elect to file for benefits prior to your full retirement age, as I mentioned, your benefit's going to be reduced, and it can be reduced by up to 30%. If you're taking it early, there's going to be a trade-off. Yeah, you start receiving benefits earlier, sure, but you're locking in the amount for your lifetime. Column 2 shows us what happens if you start collecting at your full retirement age. You'll receive 100% of your benefit. Column 3 shows what happens if you delay your claim beyond your full retirement age, so that your benefits increase monthly for each month you delay, or 8% per year up to a total of 32%. These are referred to as delayed retirement credits. Credits are available for each month past full retirement age up until age 70. Now let's look at why it's so important to plan this out. It's incredibly important that you get this right, since the amount of Social Security income your household has will affect how much of your nest egg you're going to have to dip into. Here we're showing a couple. Ronald is 60 and Nancy is 58. This graph shows what happens if they start collecting their benefits at various ages, starting with this one at age 62. The example assumes Ron will live to 85 and Nancy's going to live till 90. It shows Ron starting first because he hit 62 first. The darker blue lines represent his income. Then you'll see Nancy's benefit represented in lighter blue. So Ron starts around $27,000 a year, and then Nancy adds her $20,000 on top of that once she hits 62. And now let's look to the right at his age 85. Things change. The surviving spouse gets to keep the higher of the 2 incomes. So Nancy actually loses hers because it's lower and takes Ron's instead. That puts her back to around $44,000 a year. She's having to live off about $36,000 a year less. This can be devastating. Okay, same example, except this time, they wait until their full retirement ages, 67, to start taking their benefit. You see, it all shifted to the right, and the income is much higher. When Ron passes, Nancy's still at around $60,000 a year, and that can make a huge difference. That can keep her from having to live with the kids. And the final example, they both decide to wait and claim at age 70. Now the numbers are quite large. At age 72, they're bringing in $100,000 a year. When Ron passes, Nancy will be just fine living off the $80,000 per year. Now, here's the kicker. Watch closely. You don't want to miss this. From the original choice of filing at 62 to the final choice of filing at 70, the difference is almost $500,000. The decision reaped them a total of $2.1 million. For most people, this is the biggest financial decision they'll ever make. Remember now, we had to assume that Ron died at age 85 and Nancy at 92. Well, I can't tell you how many times I've heard people tell me that they won't live that long. Just know this. I've had many clients live well into their 90s, with my client record being 103 years old, and they all told me, I never expected to live this long. It's a fact of life. If you're a male and live to be 65 years old, then there's a good chance you'll live past 85. Women who make it to 65 have a 50% probability of living past 88. So let's stop and think, what does a 50% probability actually mean? Well, when referring to our expected lifespan, it means 50% of us make it to that age and 50% don't. So you need to plan as if you're going to be in the group that does, just in case, right? Now your plan might be, my kids will take care of me, or I'll take a long walk on a short diving board, whatever, but you need a plan. The chart also shows that if a married couple makes it to 65, there's a 50% probability of one of them living past 92. You need to get ready. All of this shows us the importance of getting your Social Security plan in place and doing it properly. We're more than prepared to help you make sure that you get the most out of your Social Security benefits, and we'll talk about how that can happen a little later on. Next challenge is challenge number 2, converting your retirement savings into your own personal pension that will last as long as you do. You may be familiar with the financial planning concept of retirement being like a 3-legged stool. The first leg would be Social Security, the second leg, personal savings like your 401k or IRA, and then the third leg being your pension. Most of us are retiring without the benefit of a pension from our employer. For most people, we depend on a 2-legged stool for retirement. So there's Social Security and then whatever you've saved up. So what you have to be concerned about is how are you going to maximize your 401k or your 403b or your IRA, TSP, whatever, to complement your Social Security so that it lasts as long as you do. A common fear among many retirees is the fear of outliving their money. Can you relate? So it's important for most of us that we treat our retirement assets with as much care as we can to protect our retirement savings. And this takes us right back to what we refer to as longevity risk, the risk of living too long. Longevity risk is so important because it's a multiplier of other risks. Why? The longer you live, for instance, the more likely the market will crash again. The longer you live, you might withdraw too much. And the longer you live, inflation can really kick in. And you might need long-term care. Over the years, my clients have shared their life experiences with me, and I've learned a lot about what a happy retirement looks like. One common thread is they have a steady income that provides for their needs. A salary, if you will, just like when they were working. Their salary is not dependent on the stock market. They know they can spend their monthly income and enjoy life because they'll receive their salary the following month. They're not concerned about depleting their lump sum 401k or IRA and maybe spending too much. That's why you must consider the importance of having guaranteed income coming in during your retirement years. The best solution is to let experts handle it for you. And by experts, I mean life insurance companies. We insure our house, our cars, our health. Why not insure our retirement? This comes in the form of lifetime income annuities. Because life insurance companies are on both sides of the longevity risk, they offer life insurance if people die too soon, and they offer lifetime income annuity riders if people live too long. So they have a built-in hedge against longevity risk. No other industry can do this. And what they'll do is take that risk off of your table, and they take the risk on your behalf. And these come in many flavors, but in essence, a lifetime income annuity rider can be structured to pay you an income that includes your principal. But if you live long enough to see the balance in your account go to zero, they continue to pay until you die. So here's how it works. John is 62 years old, and he's not very happy with his job. He just suffered some pretty drastic losses in his 401k, and he's having a hard time contemplating how he can ever retire. He realizes that his retirement is dependent on the stock market, and he feels that he's just gambling. And the stakes are way too high to be comfortable with. John is unaware that he can actually set himself up with a personal pension plan. His company's 401k, like most companies, has a provision which allows employees that have attained the plan's designated retirement age to move his money to his own IRA, even while he's working. He can still contribute to his 401k and get the match just as before. Now, this opens up many options that are not available inside his 401k. By moving the money to an IRA, he can set up a lifetime income annuity rider that will provide him a guaranteed income as long as he lives. It will not rely on the stock market and will allow him to have peace of mind that the next crash won't cut his retirement short. As an example, let's say he moves $300,000 over to the lifetime income annuity rider, and he knows that if he waits until he's 67, he's guaranteed to receive $23,411 per year for the rest of his life. This, plus his Social Security, means he can retire in style. So let's talk about these lifetime income annuity riders. They can be set up for individuals or on joint lives. The longer you wait to turn on the income, the higher the payout. The payout can be set up to increase with inflation. If you die early, the remaining funds go to your beneficiaries. It takes you from if-come planning to income planning. The no market risk strategies I use are based on contractual guarantees, backed up by the assets of very large, highly rated companies. Therefore, you can count on the money coming into your retirement. Most advisors and financial planners specialize in if-come planning. I call it if-come because you don't know if it's going to be there when you need it. If-come is retirement money that's invested in stocks, bonds, mutual funds, or any other variable account. If-come is the type of money that can be gone overnight just because of some war or economic downturn, or because some crooked CEO or bank caused your retirement to collapse. Next, we're going to talk about challenge number 3, avoiding losses. Since most Americans now rely on this thing called the stock market, let's take a look at what it can give you. Let's go back 20 years. This is the S&P 500. 500 of the largest company stocks that are meant to represent the stock market overall. For the last 20 years, it's shown an annual return of 2.55%. For the last 10 years, it's averaged 4.29%. This is before fees. Average fees run around 1.5%, so when it's all said and done, investing in stocks has not been the answer for most baby boomers. Many were convinced to participate by so-called advisors telling them they'll earn 10 to 12% a year. You can see that the actual numbers have left them far short of their goals. Even if they expected 6% per year. In this example, their $100,000 was expected to be $331,000, and it's only $165,000. That's one half of what they thought they would have. They just don't have nearly what they thought they would to make that step of leaving their employment and then living off of their savings. Earlier, I spoke of learning about what real retirement is like by talking to my clients who are retired. They've convinced me that a regular paycheck during retirement helps them budget their lifestyle without having to worry about running out of money. What makes them have even more peace of mind is the fact that they have their money in vehicles that guarantee against loss from the stock market's poor performance. The foundation of our plans includes solutions that allow us to take advantage of upward movements in the stock market while they're guaranteed not to lose your principal. And as your money grows, you'll never have to give back your gains. Again, my client's money, it's just not at risk. And since we need safety and security, we're using life insurance companies to provide those guarantees. The vehicle of choice is a guaranteed insurance contract. It earns money in good stock market years and never gives back the gains. So let's take a look at this chart. It goes back to 1998. The red line represents the S&P 500. You can see that it resembles a roller coaster. The green line, however, represents our strategy that protects your money from loss. See how in the years 1998 to 2000, the S&P 500 went almost straight up? Our strategy lagged behind, but still made some serious gains. And then in 2000, 2001, and again in 2002, the S&P 500 gave back all of its gains and then some. Notice that the green line stayed at the same value. Then in 2003, when the market started digging itself out of a hole, our strategy went up, but there was no hole to dig out of. Of course, this repeats itself in 2008 and 2009, and then again in the last month or so. So why wouldn't you want the green line? Is it too good to be true? Is there a catch? Actually, there are two catches: time commitment and maximum gain. Let's talk about time commitment first. This is going to vary from state to state, but in general, the best accounts are going to be between 5 and 15 years. You choose the number of years that you want, and after the first year, you can take out 10% per year every year for any reason with no penalty at all from the insurance company. So here's a question for you. Is 10% per year enough? All right, if the answer to that is yes, then let's look at maximum gain. There is a maximum gain you can make in any 1 year. The very best accounts, currently the maximum gain is going to be somewhere between about 18 and 24%. So here's how it works. If the market goes up 40% next year, then the most you could possibly make is somewhere between 18 and 24%. If the market goes down 35% next year, your worst case scenario is 0. So there it is. If you're okay with 10% per year liquidity and earning a maximum of 18 to 24% in 1 year, then a guaranteed insurance contract may be right for you. So as promised, we've covered the 3 greatest challenges to getting your retirement right. You learned about the importance of exploring all your possible claiming strategies and how they'll affect your quality of life throughout your retirement. You've learned how it's possible to convert your 401k and other retirement vehicles into your personal pension that you cannot outlive. You've learned how important it is for your retirement peace of mind to use strategies that protect you from market losses and allow you to know your money will be there when you need it. Now let me get all your questions answered and check out your comments. So, Bill asked, can I just ask the staff of the Social Security office what my best option is? You would think, Bill, but employees of the Social Security Administration are forbidden to give advice. They can provide information, but to get the most benefits, you're going to need to know what questions to ask. If you work with us, we'll run an analysis to find the very best plan that will allow Social Security to support your retirement. Do you charge for the Retirement Shield retirement plan? Okay, so no, we don't. It's our policy to work with you to put your plan together and then help you implement the plan. If you use our solutions, then we get paid as a finder's fee, by the insurance company. So all your money goes to work immediately. About the principal protection strategies, why isn't everyone doing this? Well, actually, they kind of are doing it. Every month, over $10 billion with a B flows into these principal protection strategies. Most of that money is coming from the large investment houses, and they're blasting the internet with negative information to protect their business. Oh, what if the insurance company goes belly up? Good question, Sharon. What a great question. These are guaranteed insurance contracts. To gain the status of a guaranteed insurance contract, the insurance company has to reserve 102% or more of what you put in. These reserves are separate, they're segregated, and they're monitored on a regular basis. So if, God forbid, the insurance company did go belly up, there's enough money in reserve accounts to pay you back. Because of those reserving rules in the history of our country, no one's ever lost 1 cent in a guaranteed insurance contract. And because of that track record, I feel very comfortable telling you your money's in a protected place. All that being said, I recommend that you do business with highly rated insurance companies. We call them top-tier financial ratings. All right, John is saying, I lost a lot of money in the stock market. Should I not wait for the market to come back before I make a move? You know, I hear that all the time. I hear people say, I've got to wait for the market to come back before I move in and get it protected. And so I explain to them that when you put your money into one of these strategies, it's not a departure from the stock market. It's not a departure from the gains of the stock market. It's a departure from the losses. So you'll still participate and come back as the market comes back. But when the market goes down, you don't lose. So you put yourself in a position where you can make the money back and continue to go forward, just never backward. You know, once they hear that, they realize they want to move sooner rather than later. Okay, here's a good question from Karen. I want to move my IRA, but I don't want to pay the taxes. The good news is you don't have to. Essentially, what we'll do, we will set up your account as an IRA, and then we'll move money over from your current IRA to the new IRA without taxation. So you don't have to pay taxes when you move your IRA. Here's another question, this one from Nancy. What insurance company is this through? Do you work with just one? There's 39 companies that offer these strategies to the general public, and we know these companies inside and out. Now, as a matter of fact, there's 4 or 5 that are the very best in the industry, and we work with those for the most part because what they're offering is the top of the top tiers, or this is the best of the best. So we know they're very, very good, and that experience that we have over the years allows us to choose the very best products for our clients. That's what makes us unique. So our time's running short, so that's all the questions I have time for, and I believe I've provided the information I promised. I sincerely hope that you'll use this information and act on it so that you can get your retirement right. One other thing I promise is the free retirement calculator. I'll be sending this to you right after this webinar, so be sure to look for the email. The calculator is called 9 to Know, and it's going to ask you for 9 bits of information to help you determine if you can retire when you want to. It'll give you an idea if you're on track and also give you a feel for what a retirement plan actually looks like. So what do you do now? You've decided that you want to know how to get the most out of your Social Security. You've decided you want to know how to set up your own personal pension plan. You've decided you never want to suffer market losses again. You've decided that you want to go up with the market and lock in your gains. Or you realize that you only get one chance to get your retirement right, and you want to know how to set up an action plan. We'd like to help. We understand you still have questions, and we'd like to give you the opportunity of speaking with us and getting all your questions answered. We're not talking about a sales call, just a phone conversation. Let's talk and figure it out together. When you click on the link to book your phone call, you'll be taken to a web page that allows you to book a time right on my calendar. Once you pick the date, it'll walk you through the process to pick a time as well. Once you're booked, you'll receive an email that confirms our appointment. My goal for this event was to increase your awareness of potential issues that you need to consider as you plan for your retirement and even during retirement. I'd welcome the opportunity to speak with you individually, to discuss your unique situation, and if nothing else, to provide a second opinion on what you're already doing. I'm a strong believer in the notion that an informed client is the best client. Education is my passion, and I've helped many go into retirement with a greater sense of confidence. Click on the link and let's talk soon. Good day.